Welcome to the meeting. I see a few people online. Great that you're able to join us. I'm Barry Coates. I'm the founder and CEO of Mindful Money. We're a new charity, and I'll talk a little bit more about that later on. We're here as the first of our weekly seminars, and it's my great pleasure to welcome John Berry. John is the co-founder and CEO of CareSaver, which is the relatively new KiwiSaver fund. I think some people are still joining us, so I'll repeat this introduction in a little while to come. But just to give you a very quick overview. We're going to run a discussion between me and John, few questions to grill John about over 20 minutes. And then we're going to open it up for questions, comments, what your thoughts are. At that stage, you'll be on mute, so you can use the chat box. So down the bottom in the middle is the chat button. So you can add a chat or a comment at any stage during the discussion. So when you think of an issue, feel free to write it into chat, and then we'll come back and we'll talk about those issues when we do the discussion, as I say, after about 20 minutes. And we'll conclude at around 40 minutes. So I hope that's all clear to everyone, and I think we'll just kick off if that's okay. Introduction to John Berry. John's, as I said, John's co-founder and CEO of an organization called Pathfinder Asset Management, and they've got a sort of pre-existing strong track record of fund management. Recently, Pathfinder set up CareSaver, and CareSaver is therefore a new KiwiSaver fund, and John's going to primarily be talking about KiwiSaver funds today. John's got a background in funds management, primarily through senior roles in the large and reputable Deutsche Bank. Last year, when John and his team launched KiwiSaver, they did so in a way that would make it ethical from the start, and we look forward to John talking about that, talking about their aims to build a reputation for strong ethics and high returns. John's personally very committed to social environmental issues, and as he'll explain, 20% of CareSaver's funds are donated to charities, and John's also very much a leader in the investment community and has been involved in a number of government processes. So without further ado, welcome, John.
Thank you, Barry. Good to see you.
Let's kick off. So, John, let me just drag up a slide here. It's a slide of funds that that have performed over the past quarter. I hope everyone can see that. This is on the left-hand side, the funds that are on the Mindful Money website. They're the ethical funds in light blue, and on the dark blue side are the major banks that collectively have around 60% of the New Zealand market. As you can see, in a downturn, the ethical funds have done exceedingly well compared to the average and compared to the major banks. So, John, the question for you is you've done well over the past quarter. Do you want to give us a quick update about how your funds performed? This is showing growth funds, but also other funds, and how a little bit about how your funds have been performing.
Cool. Thanks, Barry. Yeah, look, we're really pleased. I mean, it's been a time of major disruption in markets over January, February, March. We're really pleased with how our funds have performed. Our conservative fund is actually up, which is quite remarkable. Our balanced and growth funds have beaten the average KiwiSaver balanced and growth fund by over 5% each, which is a fantastic outcome. And really, our team we've a really skilled team. They've had a lot of late nights, some all-nighters watching markets and events unfold offshore. But we're an active manager, and that's what we do, and we need to do it. And the challenge for us is really to keep things going as the market goes forward from here. But certainly, like you're showing, ethical funds have had great performance in the market downturn, and a lot of people and a lot of evidence offshore shows that ethical companies are just more resilient in down markets, and I think we've just seen that.
Cool. And it echoes international experience of ethical funds, and also over a longer time period, the last 15 years, tracking studies show that ethical funds have done really well. So, John, how do you think you're going to go in the upturn? So a lot of people would say, well, you did pretty well in protecting your losses on the way down, but are you going to be able to make gains that are as high as conventional funds on the upturn?
Yeah, look, it'd be a disaster if we did well on the downturn and then made no money when the market heads up. But I think we're going to do just fine when the market turns up. And why I say that is, firstly, we launched in July last year. Bearing in mind, outside of KiwiSaver, we've been investing ethically for 10 years. But CareSaver, we launched in July last year. So we've had a period of 6 months from July to January where markets were going up, and CareSaver outperformed the average of the banks by about 3% in our growth fund over that period. So we've already had a track record of 6 months of up markets of doing well. Second thing I'd say is we have a real focus on hand-picking stocks and hand-picking quality stocks. So you'll see in a lot of KiwiSavers, they have 1,000, 2,000, 3,000 companies. Many of those are not selecting based on quality, they're just buying the entire market. We aim to have 200 to 250 stocks, and we're really focusing on the quality of those. And by that I mean, in this time of disruption, you want to have a strong balance sheet and good cash flows, as well as using our ethical metrics. So the sort of companies we're talking about in the US would be your Googles and Netflix, and in New Zealand, your Sparks and Meridian companies. And the other thing I'd note is why we think we're going to do well in the upturn as well is our ethical investment process. And when people think about ethical investing, it's about what do you avoid, don't invest in tobacco, don't invest in alcohol. But for us, if you're really going to have an impact on the world, it's not about avoiding things, it's actually about positively choosing things. So we use environmental, social and governance metrics, ESG metrics, for choosing our companies. And there's a lot of evidence offshore to show that in a rising market, those companies, their share price does better.
Thanks, John. So maybe one of the messages for the audience is, if you say you're going to do better than the average on the way down, you're going to do better than average on the way up, is there a right time for somebody to switch their KiwiSaver to an ethical fund, or is any time the right time? Because there's a lot of advice out there, people saying, oh, don't switch your funds. I think what they really mean is don't switch your risk category, right? Not don't switch your funds within the same category of growth funds or balanced funds, etc.
Yeah, you're absolutely right, Barry. And the way I like to think of it is you've got two trains going alongside each other, and one is going slightly faster than the other. And they're both growth trains, and you can step from one to the other and get a slightly better outcome. You're absolutely right. The two decisions for investors are, should I switch from growth to conservative because I'm worried about markets? And I'd absolutely say to people, don't make a decision like that in haste. Choose the right risk category and stay with it. I'm not giving you my personal advice, but that's just general rock solid advice, is to get the right risk category. And then we would say, choose the fund that suits you, choose the fund that matches your ethics, and choose the fund where you think you're going to get the best long-term returns.
Cool. That's fairly clear. So John, here's a tough question. I mean, CareSaver's fees are higher than many of the passive funds. And what we've been talking about is returns after fees. So you're obviously kind of doing well on an after fees basis. But can you continue to beat the market against a kind of low fees option? And how does that look? And maybe I'll just bring up a slide while you're talking.
Sure. So look, first thing to note is we want to be really fair with the way we charge fees, and we're an active manager, so we're intentionally not trying to be the cheapest in the market, but we're an active manager. To set our fee, we just took the average fee across all providers, and the average conservative fee, average balance fee, average growth fee, and we think that's fair because for our work, it involves a lot more research on the ethical side. We're digging quite deeply into companies. We have an environmental scientist on our team, and Kate, looks quite deeply into a lot of the practices and a lot of the issues that we hear about. And so the question for us is not so much what is the fee I'm paying. The question is really what do you get for the fee you pay? And if you're going to pay a higher fee, we are higher than passive. We're the average fee in the market, but we give active and agile management. So we focus on moving to cash and other forms of protection. We focus on the industries we're invested in. It became clear to us when coronavirus was spreading that you don't want to be invested in, for example, hotels or airlines. So we can exclude entire industries. We focus on quality stocks, and we also focus on currency management. The New Zealand dollar's been bouncing around, and you can either make or lose a lot of money with the currency move as well. So we're very active in our approach to that. But we're also very active in our ethical approach, and we aim to avoid harm. And the slide you're showing here, Barry, is 10-year returns for fossil fuels. Fossil fuels has just been a disastrous place to have your money for the last 10 years. It's one of the few sectors of the market that's lost money over 10 years, down 3.8%, while the US market has actually gone up by 10.5%. We have no fossil fuel companies. We're the only KiwiSaver that has no fossil fuel companies. We're the only KiwiSaver that has no companies that conduct animal testing. We have no weapons. And, for us, it's not just exclusions, it's also research into companies to choose the most ethical companies we can find in different sectors. But that just takes a lot more work for us. And that's why we can't charge the lowest fee. We don't try to, but we say to people, are you getting value for your fee? Are your returns after the fees you pay better than the market? And that's what we aim to achieve. And I think to me, that's the key thing, Barry, is are people getting fair value for what they pay?
Yeah, and I got this slide from you about returns over the past quarter, John. So maybe you just want to explain that.
Yep. Look, I'll just mention this quickly, Barry. And you put a slide up at the start which showed, different ethical funds and how they've performed, and a number of ethical funds have done really well against the market generally. And what we're showing here is us against one of the largest KiwiSaver providers. I won't say who it is, but it could be any of the banks. And essentially, as markets were rising, we outperformed. As markets fell, we didn't fall as much. And we think the ethical approach we're taking, particularly our ESG, environmental, social and governance approach, of really targeting companies that care about social issues, they care about the way they look after the employees, so they have a more productive workforce, they care about their interaction with the environment, so they're actually lower risk, because their risk management is much higher in their operations. Those companies, their share price will tend to be more resilient as markets fall, and will do well as markets rise as well.
Yeah. So we'll just carry on for another couple of minutes, and then we'll open up for chat. Sorry to everyone that you're on mute, but feel free to use the chat on the chat box, and in a couple of minutes we'll answer the questions, comments you guys have put in the chats. But first, John, paint us a picture going forward. So what does the outlook look like going forward for investors, and what are you thinking about for KiwiSaver, for CareSaver going forward?
Okay, well, the first thing I'd say is for many investors, KiwiSaver is a long-term investment. So bear that in mind when you see market volatility. And if you're contributing every month and your employer is putting in every month, you're just buying at cheaper and cheaper prices at the moment. And what we're seeing at the moment is volatility. The US market has sold off over 30% for a period this year, and then it's recovered half of that. And we're cautious and we're really selective on the companies that we're investing in, but we're focused on solid balance sheets, good cash flow, ethical companies. What concerns us when I look at the US, since the GFC, there have been 22 million jobs created in the US. In a 1 month period, 25 million jobs have been lost in the US. So a decade of growth has just been obliterated. That is worrying. New company formations, when I look at those numbers, they're down 40% in the US. The IMF has recently come out and said the troubles we're going to face now in the economy will be greater than the GFC, potentially the greatest since the 1930s. So there's a lot to worry about. What does it mean? It means you need to be selective. We're looking at technology stocks and utilities and telecoms. There are companies that, we look at Microsoft, for example. The single largest holding we have in CareSaver is Microsoft. And when you look at the Dow Jones Industrial Index, it is the one stock that out of 30 that's actually up this year. So there are places where you can make money in this environment. You just need to be very selective. So market outlook, cautious, but we're going to look back in a couple of years, and personally, I think we look back in a couple of years and we will say, I bought cheaply through this period, but it's going to be a bit of turmoil for the rest of this year, certainly.
Good. That's really good to know. And I see on the group chat there's a few comments from people around issues like that. So John, let's go through to some of the questions. I'll just flick to those. So we had one from Facebook. So from Patrick, does CareSaver have shares in Tesla?
Yes, it's our largest automotive holding is Tesla.
Okay. Do you want to justify? There's obviously a bit of concern going on there.
Well, I suppose if you think about it from a financial perspective, they are a disruptor, and they are disrupting the automotive industry, and they are the best placed out of the automotive companies to move into the EV space. Sourcing of resources is an issue for all companies and supply chains, and that's where a lot of concern is around any of the companies in the EV space, and also disposal of product at end of life. The way we think about it with an EV, electric vehicle, is the manufacture and the disposal of the of an electric vehicle is more carbon intensive than it is for a combustion engine. But over the lifetime, as long as the EV is actually used, there is a tipping point where it's much more efficient from a climate perspective to be driving an EV. But if you look at the production and the disposal, yes, there are issues around that. But unfortunately, with ethical investing, there are compromises everywhere and there are challenges everywhere, and everyone's just got to arrive at a point that works for them.
Okay. So a question from Mark. Hi, Mark. It would seem to make sense to move from a balanced fund to a growth fund in a few months' time when the market gets near to the bottom. So Mark reckons he can pick the bottom of the trough. What would you say to that?
Look, I'm not a financial advisor, and I'm not going to give any personal financial advice, but what I would say is it's really important for everyone, not just now, but a year ago, 2 years ago, 2 years in the future, to make sure you're in the right fund for your personal circumstances and for your for where you are with your savings. You've got to remember, if you're trying to pick the bottom of the market, fund managers are hopefully taking a lot of the worry out for you with the strategies we use in terms of our stock selection and protection strategies. So, if we think the market's going down, we will actually be taking steps to protect against that. I wouldn't try and pick the bottom of the market, but look, I've seen people who have moved from conservative funds to growth funds at the worst time when the US market was off 30%, and people would have said to them, you are insane. Right now, they're looking like geniuses because the market's, back up 15%. No one can time the market. They were as lucky as much as smart. But look, I would say just choose the right fund for your risk profile and stick with that.
Okay, so Anna, thanks for the question. So Anna's got some money with Generate at the moment. Sounds like KiwiSaver fund, and she's saying, is it possible to have a separate account with CareSaver that might be an investment fund rather than a KiwiSaver?
Cool. Thanks for the question, Anna. Yes, we under the Pathfinder brand. So our non-KiwiSaver company is called Pathfinder, and the website is path.co.nz, and we offer funds outside of KiwiSaver there, ethical funds outside of KiwiSaver.
Cool. Vincent, can you comment on the potential for a low emissions rebound after COVID? or is it back to our usual fossil fuels way? That's such a good question. There's so much stuff that is happening, so much thinking about that. I've been sort of part of a discussion group just before coming on air about exactly that. How are we going to use this opportunity to move to a situation where we're building back better, where we're making that transition to a low emissions, carbon resilient future?
Yeah, look, that's a really good question, because I think it's important for all of us to think of the world we want from here and not just going back to business as usual. So what we do in CareSaver is we actually measure the carbon intensity of our portfolio, and we've built a KiwiSaver. I think we're the only ones who actually measure the carbon intensity. Our carbon emissions are 80% below average in the portfolio, and we want to keep driving that lower. We'd like to see that in the real world as well. And it depends on everything from consumer behaviour. Will people be as willing to fly around the world as much as they used to? Will people be, in many countries where the sky is now clear and they can see stars, will they be demanding that from their leadership, that their skies are like that all the time? I think it's a time of fantastic opportunity, but we shouldn't just be looking to companies and to politicians for the solutions there. I think as individuals and as communities, we should be demanding change. We've experienced a quieter world and a less busy world and a lower emissions world, and a lot of people like that.
Yeah, and a more caring world as well. And there's a whole lot of positives that we can take forward, I think, if we're brave enough to break with the past and make a new future. So let's carry on with questions. Sort of back to the detail. Sarah, thanks for the question. Sarah's saying, when you say moving to cash, does that mean you're moving out a growth asset when the market's about to go down? And do you do that evenly across the board, across all your funds?
That's a good question. So with we have a range of protection strategies we can use. One of them, for example, is just taking off currency hedging, because when international markets sell off, the Kiwi dollar generally sells off as well, and we can make money that way. What we often do with our portfolios, I'm just trying to put it in the easiest terms to explain, is we can hold our portfolio of stocks but sell the S&P 500. So we actually can short an index, which includes fossil fuel companies, tobacco companies, a whole bunch of stuff we would never invest in ourselves, and put some protection on the portfolio by selling that index. And we think we actually make money because the stocks we've chosen perform better than that index anyway. So we get the differential, but we do reduce some of our market exposure. Sorry, it's not a very simple answer, but we can at times, when markets are selling off strongly, we will put that protection on just to ride out the really bad times.
Cool. This is from Joe on Facebook. Thanks, Joe. So Joe is coming back to that question of when the right time is to shift her fund. She's saying that she's unfortunately delayed moving from ANZ to KiwiSaver. She may have seen the chart showing relative returns. But now that everything's happened, I've heard that it's best to stay where I am in order not to lock in the losses. Now, this is kind of a crucial one, because this is the advice that a lot of people are getting. And I think it's very easy to misinterpret this. So can you give Joe some advice on this?
Okay, so look, I'd say if you're in a growth fund and you've just gone down 10% and you move to a conservative fund, you probably have locked in your loss, because when the market rebounds, the conservative fund will not go up by as much as the growth fund. But I would like to think at the moment, if you're in a growth fund or a balanced fund, you're like on the starting line of a marathon and you've got 20 years to retirement. You want to be the fastest runner you can be from that start line. So you choose who's going to be the fastest runner. Choose you're not locking in a loss if you're just moving from one growth fund to another. Just choose the manager that suits your values and the manager that you think you will get the best long-term returns from.
Thanks, John. Nigel, hi Nigel. A question from somebody who's obviously passionate about climate change. Do you have fossil fuel companies in your portfolio or exclude them all? And at this stage, I'll just give a little plug for Mindful Money, because you can go to www.mindfulmoney.nz and you can see what any KiwiSaver fund has in their portfolio across 270 funds. And we not only looked at the direct investments that these funds made, but also the funds that they invest in. So we unpick a whole portfolio, and that shows exactly what fossil fuel investments that KiwiSaver funds have and which companies. So you see that a lot of them have got the usual ones of ExxonMobil and Chevron and others. But there is kind of one and we have on our website a number of funds that have a fossil-free policy, but those funds haven't yet all excluded all of their fossil fuels, primarily because they've got some indirect funds, except for one fund that has completely divested from fossil fuels, and I'll let John identify which fund that is.
Thank you, Barry. Yeah, look, we have a major focus on climate change. We think, putting aside this really difficult time for communities and families and people, losing work and everything at the moment, and it's a terrible time for communities. If we look long term for the world we're leaving our children, our grandchildren, we think climate change is by far the greatest challenge for humanity. And so we've constructed our portfolio around that by not only measuring the carbon intensity of all companies we invest in, but also avoiding all fossil fuel companies, which is coal, oil and gas companies. So yeah, we have completely excluded them. And Barry, can I just expand on one thing you mentioned there, which was using the mindful money tool to help people decide what works for them. And a lot of people ask me, what should a fund manager have ethically in their fund? And my answer is, we're in this wonderful position of we've got over 30 providers in KiwiSaver, all have different views. And at one extreme, there are people that are quite happy to say, tobacco, if it makes money, it doesn't. It's been really poorly performing. But if they believe tobacco makes money, if you use cigarettes as a manufacturer requires or recommends, you will kill yourself, people are happy to invest in that and make money. There are KiwiSavers that will do that. There are KiwiSavers investing in tobacco. We're at the other extreme. We aspire to be the most ethical KiwiSaver fund. And there's a full spectrum of offerings. And I think it's fantastic for investors to be able to find and choose what works for them. And the key thing is, firstly, providers like ourselves being really open on what we do and don't invest in, but also tools like Mindful Money, which is just offers wonderful transparency for people to help them find what works for their own personal values. So good work, Barry. Keep it up.
Thanks, John. Yeah, that's an important point. And when we set up Mindful Money, we didn't want to tell people what their ethics were. So we did surveys of the New Zealand market to say what are the issues that people are worried about? What would they like to avoid when they invest? And we came up with 10 particular types of investments: human rights violations, labor rights violations, products tested on animals, weapons, fossil fuels, etc. And then basically on our website, we've got a way that you can choose what ethics are most important to you to have reflected in your portfolio. So thanks for the prompt, John, because what our website does is it tries to give you the opportunity to tailor the fund to your particular choices. Let's carry on. Dewey, hi, how are you? Dewey's asking, do you have any financial advisors or QFEs that someone could talk to before switching funds? And is there a fee for using their services?
Look, thank you for the question. Yes, we have 2 advisors and no fee for using their services. Our number is, if you're okay with me sharing it, Barry, is 0800 Ethical is our number. And yeah, we have 2 advisors who are happy to chat, no fee.
Cool. One more while we're at it. Sarah has said, love the model that includes giving to charity. How much money has been donated so far? So I'll drag up a slide that you sent me, John, while you're answering this.
Cool. So thanks, Sarah, for the question. Our focus as a business is as a social enterprise. And if you're not familiar with the term social enterprise, it means a business that is also looking for social or environmental outcomes, as well as offering a great business service. And for us, what we're focused on is helping charities develop renewable passive income that will come to them year after year. And we've seen, particularly now where there's so much need for charitable services, and funding is really, really tough for charities at the moment. And look, I'm on the board of the Men's Health Trust. I've been on that board for about 5 years. Our biggest challenge, and we do wonderful work in terms of educating men around lifestyle and health, and it doesn't just benefit men, it benefits their families and their communities. Our biggest challenge is funding. And so the idea we have here is to develop renewable income streams. Remember, Barry, at the start, I was talking about how we charge the average fee in the market, which we think is a fair fee, and then we give 20% of that to charities. So anyone who joins us chooses one of our 17 charity partners, and 20% of the fees that you pay, we will give to that charity. And social enterprise model means that's not a cost to our investors. Because we're charging the average fee in the market, that is a very fair fee for us to charge. Our investors direct where it goes, and the cost is essentially to my shareholders. So we've got 17 charities at the moment, and I'm pleased to say we're looking at adding one at the moment. One of the biggest social challenges at the moment is looking after our communities, and we're talking to a food bank charity about adding them shortly, which will be our 18th charity.
Cool. John, we'll wrap up in a few minutes' time, but I just wanted to sort of come back to the challenge in this, that for a lot of people, the whole concept of kind of ethical investing is something instinctively that they like and they want to do. There's concern about sort of greenwash, there's concern about so, well, are you really ethical or not? Do you want to just talk a little bit about your views on the ethical choices and how far you think CareSaver can go before there's an unacceptable penalty to being more ethical and excluding just about everything from your portfolio, for example?
Yeah. Okay. So in terms of being ethical and setting our ethical policy, the key thing to us is around transparency, and we have an ethical investment policy that explains in some detail what our views are around climate change, around animal exploitation, and then we build our investment policy off the back of that. So key thing for us, when I read those policies for some providers, I walk away thinking I really don't understand what they're going to invest in or not invest in, and hopefully it's clear with us. But we're also about engagement with our investors and with people who want to invest with us, and we're really happy people saying what about this and challenging us. And social values change over time. During my lifetime and during our lifetime, there's been massive social change, and change will continue. And we've already once this year have updated our ethical investment policy around animal exploitation. And one of the questions you asked is around when does it become a cost. And so if you think about the two sides of ethical investing, one side is exclusions, and we exclude fossil fuels, which actually help portfolios. We exclude weapons, which until this year, weapons have been slightly better performers than the market. Those things tend to kind of balance them out. I noticed this year though, like Boeing is down 56%. It's been absolutely slammed, but generally weapons have been slightly better performers than the market. But we'd say between them and some of the other exclusions we have, they're kind of neutral. You don't want to exclude your universe too widely, but the other thing we focus on is this positive investment. I'm trying to choose ethical companies that care about the environment and society. We think they make better investments, and we target 200 to 250 of them. So we're building a portfolio that we think will behave similar to the market, but will outperform the market. And you have to have limits in terms of what you won't invest in as an ethical investor, but the more important thing is choosing the good stocks, choosing the stocks that are going to have an impact as well as make money.
Yeah, I think that's a really good message to end on. John, thanks very much. We're really grateful for you coming to share that information. For all of you out there, we're going to be running these for the next 9 weeks. Same time, 4 o'clock on Thursdays. Next week, we've got David Beattie, who's the CIO of Booster. And they've also done well during the downturn. Then we've got, next week, Simplicity. It's Andrew Lance from Simplicity, and then David Beattie from Booster the week after that. Further on down the line, we've got Mary Home, who's going to join us talking about financial advice. We've got Roger Spiller, one of the founders of ethical investing advice in New Zealand. And then much later on, we've got Sir Jonathan Porritt and hopefully Kate Rayworth to join us internationally, Simon O'Connor from the Responsible Investment Association. So lots to look forward to on Thursdays at 4 o'clock. Thank you very much for joining us. Check out the Mindful Money website, www.mindfulmoney.com.